Welcome back. A small give back for the market. So 5,500 just holds for the Nifty. Let's tell you what's dragging the market down. Not a whole lot. Gale is a bit soft today. Cairn as well. So generally the energy space is sulking, and ONGC as well is about flat. JP Associates snaps its 3-day gaining streak, and that has slipped into the red. And there is a little bit of sluggishness on heavyweights like Infosys and Lever. Otherwise, no big developments in the market. Things have actually been quite steady in the first hour or so of trading. But yesterday we were talking about the ELSS schemes and whether or not that has got any more interest. ULIPs, that's the other one that's been hotly debated. Two gentlemen talk about what the trend has been there. Sumit Ved and Kamesh Goyal. Gentlemen, morning to both of you. Kamesh, let me start by asking you for a bit of a backdrop in terms of whether ever since the new changes came in courtesy SEBI, has there been any increase in ULIPs as a product? Because they're actually more friendly now for retail investors.
Absolutely. I think first of all, good morning. And I would not say that the changes came courtesy SEBI. I would say that the changes came courtesy IRDA. And actually, we have to see three things in mind. One is that the product has become extremely customer friendly, but because I think the margin for the distributors has been reduced dramatically. And also the fact that last 4 or 5 months, the market has been a bit more volatile. We are seeing lesser interest in the ULIPs on the regular premium side. And we have seen in the last 4 months that the business is shifting more towards single premium, and within regular premium it's shifting more towards traditional policies. So this is actually, in my opinion, a bit sad that when the product has become good and when the valuations in the markets are lower than where they were about say in October, November, that we are actually seeing reduction in the sale of ULIPs.
Let's get in the other expert as well. Sumit, come in on this point because, one reason perhaps for the reduction of ULIP schemes is because of the resistance to change that many of these investors have had. And with these new ULIP, guidelines coming out, many investors have been quite wary. Lock-in period increased from 3 to 5 years. ULIP pension products, they don't have any partial withdrawal, etc. How would you really address these problems for an average investor who's watching us and perhaps interested in investing into ULIPs or into the ULIP schemes, but is still quite skeptical because of the changes that have been underway?
Good morning. My response start from where Kamesh left, in terms of ULIP becoming much more investor friendly. And also one point which Kamesh was talking about is that the challenge is not at the investor's end as much as at the distributor's end, and that's where the whole industry challenge is, where the financial advisors are being known as distributors, and till the time financial advisors are not advisors and distributors, they'll always try and see a product from a pricing point of view. So as a financial planner, which I'm representing, from a Freedom Financial Planning point of view, we are very, very happy with these changes, and the way we are articulating in our financial plans, we are seeing traction of ULIPs coming up. And the real challenge out here is to educate the end investor on importance of doing financial planning, and within financial planning articulating financial goals and attaching long-term products like ULIP, which have some inherent advantage. So if you follow this process, it is getting acceptance. So it is more of a distribution challenge to me rather than investor acceptance challenge, because if being properly positioned, they are very open to it.
So what are the numbers looking like, Sumit, in terms of the demand for ULIP? How much premium has it been able to mop up in Q4, considering most of the demand comes in now?
I'm not a industry expert from a number point of view, but definitely the numbers are not as good as it was last time. Again, the relevance being it's not being pushed that much by a distributor as much an endowment plan is being pushed up. So that kept aside, I'll again reiterate, if you can articulate the importance of ULIP over a long period of time with some embedded benefits like asset allocation, investors are buying, especially with financial planners like us.
Any confusion right now, Sumit, on the tax benefits with ULIPs? Because that has also tended to be a bit of an overhang in the last few months.
I think confusion is overall there in the air, especially with DTC coming in. So I'll also explain you the positioning of ULIP. The way we see ULIP is one of the biggest advantage for ULIP is that when you do a progressive asset allocation, let's say you're planning retirement, And as you move towards your retirement age, you can easily allocate between debt and equity and keep changing without having a tax impact as of today's tax laws. So what we don't know, or what I think most of us don't know, is post DTC what will be the treatment. So yes, there is an overhang of confusion, but that confusion is in fact in all tax saving instruments. So we can't be very sure of what is going to be next year and then to next year tax treatment from that point of view. Having said that, as of today, I think clarity post the new IRDA norms is much more there than what it was there earlier, keeping DTC aside.
Kamish, two-part question to you, as was just earlier asked. What do you think the collections might look like this year from the ULIP product in specific? And second, how long before this distribution issue is sorted out? I think it's been a year and a half now that the industry has been suffering on that end.
Sure. I think if we really look at in ULIPs, the real mobilization was happening through regular premium. And if we see the industry figures for last 4 months or so, the regular premium overall is down by about 30% or so. And my sense is that if we look at purely ULIPs, as of now the bifurcation is not really published. But my sense is if we compare the last 3-4 months figures of last year with this year, the collection of ULIPs would actually be down by more than 50%. I think whenever this debates about distributors' margin and agency commissions, etc. come up, people always, a part of, I would say, people always push for a lower cost because they feel it's better for the customer. I think I have always been in the last 1 year advocating that though the cost of ULIPs had to be brought down, but if you bring it down too much, then you actually have an exceptional product which nobody wants to sell. And I think in case of ULIPs, unfortunately, that is what has happened. So when we really see this, to answer your second question, we need to see things now from two perspectives. The first is that if we reduce the margin for distributors a lot, then there are actually very few people who want to sell this product. And we need to keep in mind is that most of the distributors and agents in an economy which is really growing today and the jobs are rapidly growing, it is anyway very difficult to find people who are ready to work for agency as a career, because it is not very lucrative from a perspective of the margins which you are getting today, and secondly there is no fixed salary. So I think that is one area where I would say industry is really suffering and something needs to be done. The second is the commissions for non-ULIP business continue to be where it is. So the arbitrage has, from a distributor's perspective, has actually become quite a lot. So my personal opinion on this issue is that going forward, we need to really increase the commissions in ULIP if we want to see the benefits from a customer's perspective. And I think as my co-panelist said before, when you see ULIPs, there are 3-4 advantages. The first is you could actually select a sum insured which is more or less in the same premium. You don't have that flexibility typically in case of traditional products. The second thing is that you could do a dynamic asset allocation either yourself or through funds like balanced fund or funds where debt equity portion keeps changing every year. And all this actually is tax-free in the hands of the customer. So from a customer perspective, when the product has become much better, it offers huge benefits, especially from a post-tax return perspective as compared to other financial instruments. We are actually seeing a huge dip in case of ULIPs. So my personal request to the regulator would be to please look at increasing some amount of commission in case of ULIPs so that the distributors find it lucrative enough to push this product from the customer's perspective. And I would also request everyone who participates in these debates about higher distributors margin, that when you don't really have people who will go out and sell a product, is that better for a customer, or is it better that you actually pay a reasonable commission to the distributor?
So Sumit, as a financial planner, that brings us to the basic question. Would you recommend an investment in ULIP schemes as a tax-saving plan? And how much of a percentage of one's portfolio should it be? And if you have any recommendations in terms of schemes as well?
Sure. The approach which we use in our advisory practice as a financial planner is, for us, our core starting point is a financial plan, and which is what we insist to all our client families whenever we start a relationship. So in a financial plan, we help articulate their dreams and prioritize them into goals. And each goal then has a risk profile attached to that goal, and along with that an asset allocation. Now in asset allocation, your goals can be, something like as long term as retirement. And any goal which is 10-year plus for us, whether it's retirement or children's education, we try and bundle ULIP into it, because our thumb rule for advising ULIP is that it's a long-term instrument. We need to look at 10-year plus kind of a horizon, because that's where the difference between net yield and gross yields really reduces. Expenses get spread out over a period of time, and you are able to get an inherent benefit which is there in this instrument of being able to progressively asset allocate as you get nearer to your goal term. So from an asset allocation point of view and long-term strategy point of view, 10-year plus, ULIPs fit in, and that's where we try and articulate ULIPs into our strategy. So our view is very clear: 10-year less, look at mutual fund; 10-year plus, ULIPs look much better. And that's where there are two recommendations which we keep actively suggesting to our clients as a part of financial planning is ICICI Prudential's a lifestyle fund, where there's an auto asset allocation which is linked to a targeted date, and as you near that date that allocation changes. That's one fund which we recommend. And the other one is HDFC Young Star, which is linked to a child goal. Now the benefit of these two plans are they are long term in nature. The underlying portfolio both in equity and debt are being managed from a long term perspective. The performance vis-a-vis benchmark has been very decent, and it really adds up if you are able to manage your asset allocation strategy linked to goal. So that's the primary strategy which we are using for ULIPs.
Kamish, before we thank you, just one quick word on how much debt is attracting attention amongst retail investors as an instrument. I mean, we saw the kind of response there was to the SBI bond issue. Is it FDs and debt instruments where there's the greater draw this year?
Absolutely. I think people are looking at more from a returns from a guarantee perspective. And if you look at life insurance industry in the last 4-5 months, the single premium sales have been very strong. And most of the single premiums which are being sold have some minimum guarantee. So typically, I think what we are seeing, I would say from a insurance perspective, is that people are preferring to move towards single premium with some sort of a guarantee. And I think the fixed deposit rates have been very strong in the last 2-3 months, especially by a few banks. So I think there is, in my view, a competing option for customers between life single premium policies and fixed deposits. The only thing I would request customers and investors and policyholders to look for before they decide whether they should go for fixed deposit or a single premium plan of life insurance industry is please see returns from a post-tax perspective, because that could make a huge difference to the customer when he receives the money.
Gentlemen, thank you both for participating in this discussion. That's ULIPs for you, still not quite out of the woods it seems, but at least some money interest has been picking up lately in the market courtesy the DIIs. Let's take a break on that note. When we come back, some global opinion.